Hi there, it is Corey here, founder and CEO of Verse Wealth, and today we have got our 2023 market update and a bit of a look into the future. And I am joined once again by managing partner of Drummond Capital Partners, Tom Schubert. Tom, thank you for joining us.
Hi Corey, thanks for having me.
Yeah, you're welcome. Now I know you're coming to us live from your new larger office, mate. Looking pretty sharp there.
Thank you. Hope you can hear us okay.
Yeah, the audio is perfect, looking good. Hope you had a nice break. I won't dive into your break, I'll dive into the update now. 2022 was a very interesting year for markets, a tough year for basically all asset classes, shares, property, bonds, even cash, with inflation at 7-8%, cash was delivering, in real terms, negative returns. Hopefully 2023 is better, but there's still plenty of things to work through from an economic standpoint. So we're here to have you help us work through that and give us your views on the current state of the market, the economy, and a bit of a look, as I said, into the year ahead as well. So with that in mind, maybe let's backpedal. Tell us, quickly, kind of what happened in 2022 and what were the key themes that were affecting kind of markets and the economy more broadly?
Yeah, sure. So 22, as you rightly point out, was an incredibly tough year for markets. So if we look at bonds and equities and real estate, and really speculative areas of the market fell a lot, and primarily the big driver of that was inflation, and in turn the central bank's response in hiking interest rates quite aggressively. So at a pace that we haven't seen for a long time. We essentially went from 0 in the developed world at the start of the year to 3% in Australia and north of 4% in the US. Even Europe, which has struggled to get off 0 for a long time, hiked interest rates substantially last year as well. Japan abandoned, after decades really of zero rate policy, their own as well. And I think the markets have continued to sort of underprice the persistence and stickiness of inflation. It's been a long time since we've had an inflation problem, and so a lot of participants, I guess, underappreciated how elevated it was going to be and how much work was going to be required by the central banks to bring it under control. And to some extent, that will remain, we think, a broad theme this year, because if we look at the sort of price pressures at a headline level, some are coming down. We have seen some moderation in commodity prices. We have seen some moderation in some of the unusual goods prices, like cars and semiconductors driving shortages of chips. Like supply chains and the goods side of the equation sort of got under control, and that's been a good news story on inflation. But we're still operating in a relatively hot economy, so unemployment is low. You don't have to go far out on the street to realise that the consumer, despite the headline data, still seems relatively buoyant. There's a lot of activity, people are still travelling and spending money, and wages growth is coming through. And so to the extent that continues to keep inflation above target, it means that the central banks continue to need to hike rates. And so we're not kind of done with this cycle yet, if that makes sense.
It does. I mean, in terms of inflation, like you've kind of said recently, you think it's probably peaked, but given how persistent it's been, you said you think a recession is probably required to bring it under control. So just tell us a bit more about that, and why is a recession required, or something that would help us bring it under control?
Sure. So if we sort of break down inflation into the good side of the economy and then the services side of the economy. So the good side, as I sort of alluded to before, supply chains have caught up. The friction that was sort of through COVID and the imbalances that took place in global trade have largely washed through. And so we're seeing a moderation in goods prices, easing in supply chains. So that's sort of taken care of itself. And at a headline level, that's helped bring headline inflation down. But the sticky component and the larger component of inflation is that services side. Remember, we are primarily a services economy in the developed world. And so, wage pressure tends to be stickier, because we all go out and experience the higher inflation in utility prices and rents, and then we go and continue to demand higher and higher wages. And that sort of takes longer to feed through, but is more likely to be more persistent. And that's really looking at this core inflation number. So headline inflation, we think, has peaked, and certainly in the US, we're seeing it roll over. Australia lags on the data, so it's still peaking, like we saw an elevated number again in January in Australia. But the issue is that core number. it's still above target. If we sort of go to what the central banks are targeting, it's sort of 2% in the US, 2 to 3% in Australia is the band that they're trying to get us towards. And we look at core inflation, you know, it's been flat for 3 months. It's not falling. So it's still elevated in the US at 6. It's a long way to get it down to that 2% target. And so just because we're seeing a peaking in inflation, that's good. But ultimately, we need to create slack in the labour market to take pressure off wages and wages growth. And unfortunately, the only way to create that is through some sort of moderate recession, like a contraction in activity. And that's why we say that a recession is required. It's sort of partly what has been required in history, but it's just to do with the nature of inflation and the fact that it's now services driven as the problem.
Yeah, so we need to see unemployment rise. And that will be a leading indicator of us really getting on top of the inflation and slowing down the rate hikes and getting back to more normal settings.
That's right. From a markets perspective, what we're looking at is the unemployment rate is quite a lagging indicator. So it's 6 months in the rearview mirror in essence. So what we're really interested in is the sort of the wage tracking data and also job openings. So how many businesses are looking for people versus how many are available to enter and take up those jobs. Does that make sense? Because that's the gap between the two is a real indication of the ongoing pressure for wages to fill those vacancies. And so once they start to come down, and they are starting to come down, but they're still elevated, then we can start to understand that we're probably at a peak around the core number on the services side as well.
So in terms of moving us towards a recession, we're going to need more rate hikes to get there. Current cash rate here is 3.1%. PAC is forecasting another 75 basis points between now and June. That would take us to 3.85. Standard variable home loan would be probably close to 6.
6 going to 7 in some instances, yeah.
I mean, do you see it similar to Westpac? Do you see kind of the cash rate going up another kind of 75 basis points from here?
I think so. I mean, again, the strength in the economy kind of required two things. One, it's our policy is not just dependent on our economy. Like we're an open economy, and so to the extent the US is probably going to peak at 5, we're going to have to get a lot closer to that number because otherwise we have a weaker currency, and a weaker currency is inflationary. Secondly, China reopening, and we can talk about that in a second. They've abandoned zero COVID. They're reopening. They're coming here to spend money again. Our education sector, our tourism sector will benefit from that, but also our resources sector. So China reopening and growing probably above what people expected this year, based on that change, is also inflationary for Australia. So when you kind of put that together, the relative strength of the domestic economy, China reopening, the fact that the US is still going in terms of rate hikes, we're not done yet, unfortunately. That's just the nature of the beast. We're going to have to continue to hike patiently, I think, as the RBA has done, another 0.25 followed by another 0.25. But the sort of talk that we're done or rate hikes around the rate cuts around the corner, we think is just premature.
Interesting. So changing gears a little bit, looking at share markets thus far this year. I mean, January is the antithesis of the Jan we saw last year. We've seen a bumper January so far. The Aussie market's up 8% for January. The US markets, the S&P 500 is up about 5%. The US tech market, the NASDAQ, is up 10% thus far for January. So I guess share your views on that. And do you see this kind of rally as perhaps being short-lived, or is it potentially the end of the bear market that we've been in?
In some ways, I think, we're not calling the end of the bear market, probably first and foremost. Australia continues to benefit from relative strength of the domestic economy and its position in the world with respect to resources. So over a third of the Aussie market is resource stocks. And so the big news in January, which is probably the upside surprise that's really driven this increase in risk appetite, has been China fully abandoning zero COVID. Like that was a policy surprise. And so that's, they're out trying to grow. They're a big economy. They've been locked out for a long time. And so that's given, risk appetite a boost, but in particular commodity prices and in turn, Australian equities. And so that's probably been the story on the Aussie side. The US is a little bit different. Like you mentioned the NASDAQ, which is the tech names. That was the area of the market that's most interest rate sensitive. It's also the area of the market that fell the most last year. So if the US market in the S&P was down 20, the NASDAQ was down over 30. And so a lot of the rebound, so far this year has been in the US driven by the expectation that inflation is peaking, and so interest rates are also peaking, and therefore the interest rate sensitive parts of the market that were the most sold off last year bouncing back and dragging that sort of broad market higher in terms of risk appetite, if that makes sense. So we're not kind of calling the end. It's likely we're probably going to stay in this sort of range-bound environment. If we actually look at the US, it is at the same level it was at the start of May last year, despite quite a bumpy journey through June and then back through another rally, through another sell-off into year end. And so we've been on quite a wide range despite going nowhere in the US now for 8 months. And arguably that range may continue for some time as we try and get to the peak in the cash rate and try and see that core inflation number moderate. And also, what is the real impact of China reopening on the world? So how much does it boost global demand? Likely it's going to be a lot of internally driven consumer demand. So the consumer's been at home. Think about our own reopening story. We all went out to the shops, to the cinemas, to restaurants. And so it's very internally driven demand, like out of the house. And to the extent it may look a bit different than previous episodes of China booms, which were bigger drivers of global growth. So they were building more houses and roads and bridges that required a lot of global resources and imports. That may be less so in this recovery. It's more about their internal economy and getting that consumer back.
Okay. Staying on the topic of the recession, and I have asked you this question a few times in the past, because you probably for 9 months been saying a recession is likely and now saying it's kind of an inevitability. What potential effect might that have on share markets?
So it's really about earnings. Ultimately, share prices follow earnings. And so what we're interested in is, one, what sort of recession is it going to be and the magnitude of that recession, and therefore what's the impact on earnings? And to that extent, what's therefore priced into share markets already? And so if we look at estimates for earnings in 2023 have been coming down. It was not that long ago they were very positive. They're now sort of close to flat. But in a mild recession, earnings tend to fall between 10 and sort of 15%. And so the market's slowly adjusting to the possibility of that recession. If we look at why we say it's more than likely, there's three big, our growth barometer is at levels that suggest a recession. If we look at the US Conference Board leading indicator and the level that it sits at, it's never not led to a recession in the US in 50 years. The yield curve is another sort of forward-looking indicator of recession, so the difference between long-term and short-term interest rates. Again, it's got a 7 out of 7 hit rate in the last 45 years for predicting a recession. It's also there. So if we don't have one, we'll be resetting the rule books across a number of different sort of leading indicators that markets and economists look at. And so we think that that's going to happen. And so therefore we go, well, what is in the price? And so we look at the market's estimates for earnings, and again, they're flat. They're not down 15%. And if we then mark in that decline, then they're not really that cheap. And so we think that there is still some, particularly from the current level after the January bounce, there's potentially some downside risk to earnings and therefore share prices. But we're not in a GFC. It's not a crash. But it's hard to see markets going up a lot from here in the absence of earnings growth, not earnings falling, and also just where valuations sit today. They're not cheap versus history.
Thanks for sharing. I think there's plenty of people out there probably listening to this that have, got plenty of cash in the offset account, or perhaps they're coming into money and they're thinking about, is now a good time to be putting money into markets? And they've fallen a lot in 2022, have just bounced a bit in January, but there's still perhaps more volatility to come. I think the answer to that is yes, but progressively, there's going to be volatility. So we might be range bound for a while. So not trying to pick the bottom of markets, even though they might go lower from here. I'm just beginning to stag your money into your superannuation, your investment portfolio, your family trust probably makes a lot of sense at this point in time. So
just averaging in, if we talk about, back to the point that it's 8 years it's 8 months, I should say, of going nowhere, but quite a range. Like if you're progressively buying in, using that volatility to your advantage and averaging in, then you're going to set yourself up for when inevitably, the concoction comes. Usually markets bottom. So you see that, oh wow, we're in recession. It's sort of like the central bank cuts rates. When the economy feels the worst, it'll be the best time for markets, and that'll be the point where you want the next bull market will commence. And so you don't know exactly when that is. At some point in the next, 6 to 12 months, and you want to be invested for that ultimate recovery. So use it to your advantage, as you say.
Yeah, absolutely well said. I think the economy quite often is 12 months behind share markets. They're forward looking, and I think it's a really important point to emphasize, because I think the average punter out there thinks they're far more correlated at least in the short term than they are. And just going back even to 2020, looking at COVID, we were in the depths of the most severe recession here and globally we've seen by a long way. And at that point in time, markets had 6 of the best months they've ever had. So
that's right.
A good recent example. Tom, I think we've covered a fair bit of ground. Thanks for your insights, as always. We're looking forward to back on multiple times over the course of 2023. Good luck to you and the team at Drummond this year. Thank you for your insights, as I said, and looking forward to talking with you again soon.
Thanks a lot, Corey.
Thanks.
See you next time.
Bye.